Hey everybody, welcome to chapter 1 of Con 217, or Introduction to Financial Accounting if you're taking it at a different university. This is an intro chapter, so we're not going to get into any of the the technical things. We're not really going to learn how to record transactions. This first chapter is all about understanding what are the four major financial statements. Again, don't worry about making them. We have entire chapters dedicated to that coming up. So we'll talk about the four major financial statements that this kind of whole course revolves around. We'll talk about obviously the key elements for each of those statements, and then at the end we will talk about the different forms of corporate structure, business structure. What is a corporation versus a proprietorship? So it's not a huge chapter. It's really just a foundational chapter. In chapter 2, that's where we will introduce the accounting system, and that's where it really starts to, where this course really begins, okay? So financial accounting, the purpose of it ultimately is to take all of the information from all the events and all the transactions that took place over a period and to present them to people who are interested in this information in a way that is organized, it's complete. We'll talk about the different assumptions also in the next chapter, but ultimately we're making financial statements, right? Like if I want to present the information to my users, it is done through financial statements. Every company, public or private, will prepare financial statements. Now, if you're a private company, it's a little bit different than if you're a public company. I actually think we get into that at some point. Let me see. Yeah, here, the accounting standards. Okay, so financial accounting is really meant, its general purpose. So versus say managerial accounting, which we'll get into in a different class. Managerial accounting is more specific purpose. It's done, again, for specific reasons. Financial accounting is general. It looks at the entire company. So the first statement is called the statement of financial position. We often refer to it as a balance sheet as well, depending on which standards you're using. So for example, if you're using IFRS, we'll talk about that later, we call it the statement of financial position. US GAAP, ASPE, so it calls it a balance sheet. I like the word balance sheet because it's a sheet that shows you your balances, all of your account balances. That's where the name comes from. But statement of financial position is also nice because it really is that. What is your financial position? Like at a specific point in time, what do you have? And that's what it is. So the statement of financial position shows you, first of all, actually, before I get into it, unlike the other three statements that we're going to see, the statement of financial position is a snapshot. What does that mean? It means that it shows you all of the information you see is at a specific point in time. It is not it's not a summary for a period of time. So it's like checking your bank account. If you check your bank account today, let's say today is the 11th of May, your bank account is telling you how much money you have today at this moment. It's not telling you how much money you made this year. It's not telling you how much money you spent this year. It's showing you what is the current balance today, not yesterday, not tomorrow. That's what a balance sheet is. That's what a statement of financial position is. It's a statement that shows you all of your account balances at a specific date, and generally that date is the year end or the quarter end, depending on when it's being prepared. Okay, so you can see here, this is the statement of financial position as at December 31st, 2025. Again, it's not for the entire year. It's just on this particular date. So the information you get on the statement of financial position, you have three categories: assets, liabilities, shareholders' equity. Everything in financial accounting comes back to this or ends up here. Assets are, and I have kind of a summary of that here. Okay. Assets are everything that a company owns. Okay, so there's a specific definition: resources owned and controlled by a company that it can use to provide future economic benefit. Basically, it's anything that the company owns that it can use to earn money in the future. A building is an asset. It's a thing. The company owns it or controls it, we use that building in our business to for whatever. It could be an office building, it could be a factory, it could be whatever, but we use it to generate future economic benefit. Cash is an asset. Cash is the ultimate asset. It is money that belongs to the business that we can use for future. We can use it to invest. We can use it to pay for salaries. We can use it to do all these things that will provide a future economic benefit. Okay, so assets are all of these. They could be tangible or intangible. We're not really going to get into that. Actually, we have the notes there. I might as well talk about it. So a tangible asset is an asset that you can touch, like a building. It could be intangible as well, which is more like intellectual property. They could be financial assets. So that would be things like money you're owed, cash itself. We'll get into those details as we work through the course. But the point is, an asset is anything that belongs to the company that can be used for future economic benefit. Current versus non-current, this really refers to the life of the asset. Most assets are current in this class. A current asset is an asset that you plan to use or can be used or can be turned into cash within 12 months. Non-current assets are assets that we are going to use or turn into cash in a period longer than 12 months. For example, a building. When you buy a building, it's generally not to use for only a few months. We typically buy a building to use for many, many years. That is a non-current asset versus a pen or a pencil. When I buy a pencil, I don't expect that it's going to last me 20 years. When I buy a pen or batteries or supplies or Windex or whatever, these are very short-term assets. I expect that they're going to last me maybe a few months. Those are current assets. Okay, we'll get into, I think it's the next chapter where we'll really go deep into it and we'll talk about how to make the statements. But right now, keep in mind, current is a year, non-current more than a year. Okay. Then you have the liabilities. Okay. As far as who owns the assets, we'll get into that in a second. Okay. So liabilities. Liabilities are the debts of the company. All of the financial obligations owed by the business. Again, they could be current, just like assets, meaning that they have to be paid within a year. And when I say within a year, I mean within a year of the date you see here. So all of these liabilities that you see in the current section, these are all things that we have to pay within 12 months of this date. Non-current liabilities are debts we have to pay in a period longer than 12 months. So this $550,000 here of notes payable, we owe it, but it's not due within a year. In either case, this is money we owe to people who lent us money, who provided us credit. It could be customers who gave us money in advance for a service, right? Any financial obligation, it doesn't have to be debt, usually is, but it doesn't literally have to be like, I owe you money. It could literally be your customer gave you money in advance for a service, for example, you guys, right? Maybe you bought this course a week ago. Cut that. Let's go back. Liabilities don't have to be literal debt. It doesn't have to be that somebody lent you money or you borrowed money and you have to pay back money. It could be a supplier who sold you inventory on credit and you have to come back and pay them later. It could be a customer who gave you money early and you're going to provide the service later. Any obligation you have that is a financial obligation is classified as a liability. And the people that you owe it to, or the entities that you owe it to, they're called creditors. And the third section is shareholders' equity or owner's equity. So this has only two accounts, and we're not really going to get too deep into those two accounts. But essentially what shareholders' equity as a whole tells you is, what do the owners of the business actually own? Like, what is the value that belongs to the shareholders, that belongs to the owners? Now, what do I mean by that? And to understand that, we want to go back to the accounting equation. This is the accounting equation. It's the golden rule. The whole concept of financial accounting is built on this. The company's assets, which we spoke about already, this is everything that the company owns. So all the cash, all the buildings, all the equipment, all the inventory, right? All that stuff. Who owns that? Yeah, the business owns it, but who really owns it? Well, first of all, your creditors own it. Because when you borrow money from somebody, you have a legal obligation to pay it back. You have a legal obligation to pay it back. So your creditors technically have the first right or the first rights to your assets because they have to get paid. Now, if all your debt is paid, the shareholders get the rest. So try and imagine this, okay? And we'll do a very, very, very basic example. You and I are going to start a business today. We're going to invest $10,000 into the business, okay? We're going to put $10,000 of cash into the business. So now let's look at our accounting equation. Assets equals liabilities plus shareholders' equity. Now the business has $10,000. Cash is an asset. We have no debt. So that entire $10,000 belongs to the shareholders, belongs to you and I. We just put it into our business. But if we were to close the business, think about it this way. Shareholders' equity is the amount that if you were to shut down the business, okay, and take all the money out, how much would actually go to the owners? So here in this example, all of it will go to the owners because you have no debt. Okay. Now let's say we took out a loan of $5,000. Okay, well now let's look at our accounting equation. Same thing, assets equals liabilities plus equity. Now we have $15,000 in cash. Do we not? We just borrowed $5,000. We have the $10,000 that we put in plus the other $5,000. But if I were to shut down the business, who would get this money? Well, $5,000 of that would have to go to the creditors. We borrowed that money. So $5,000 belongs to the bank. The other $10,000 belongs to us. And I know this seems obvious, but you can apply this principle to the most complicated or seemingly complicated case. All of a company's assets, first and foremost, belong to the creditors. Any remaining amount or any remaining assets belong to the shareholders. Okay? And that's why I tried to write it as an equation. I put it as a pie chart. This pie chart represents all your assets. Part of it belongs to your liability, it goes to the liabilities, and part of it goes to equity. Okay? As far as the components of equity, there are two, well, there are many if you're an accounting major, but there are really two very high level categories. Okay, you have contributed capital. Contributed capital represents the money invested into the business. So the total amount of capital invested into the business. Retained earnings is the profits that have been reinvested into the business. So let's go back to our illustration, okay? You've been following the story. We started off by investing $100,000 of cash into the business. Then we went and took out a $5,000 loan. Okay, and then we ended up here. Now let's say during the year, we had our sales, we had our expenses, we ran the business, and we ended up making $20,000 in profit. And let's assume, just for the sake of simplicity, it was all cash. Well, now, we have $20,000 in cash. So on the left-hand side, that's an asset. Our assets went up by $20,000. So now we have, if I add $20,000 to this, $35,000. Right? $35,000. Let's assume we didn't take on any more debt. So we still have $5,000 in debt. Who gets this money? If we don't have any additional debt, who does that $20,000 of profit belong to? Well, it belongs to the owners. So we're going to add it to the shareholders' equity. So now the shareholders' equity is going to get that 20,000 and go up to 30,000, right? I'm adding basically 20K here. Okay, so let that part sink in for a second, okay? We made $20,000 in profit. We didn't take on any more debt. Therefore, the owners, the shareholders of the business, which is the owners of the business, that's their money. Okay, good. So now let's break this down. 10,000 of this was that cash that we had invested initially. That's what we call contributed capital. The other 20,000, that's called retained earnings. So the owners own those two things. The owners own the money that they've invested into the business. It still belongs to them. It's just invested into the business. And they own the company's profits. They're categorized separately, but that's what these two mean. Okay? And whenever we decide to take money out of the business, and this happens all the time, right? Think of you might have a business, or you might know somebody who has a business, your parents might have a business, they take money out. I'm not talking about salaries, I'm talking about actual profits. The owners of the business will eventually take money out of the business. What's the point of having a business otherwise? And so we call those dividends. Whenever profits are taken out of the business and given to the shareholders, that will come directly out of your retained earnings. Again, we're not going to get too far into this. We're going to talk about this more as we work through the semester. But dividends refers to profits taken out of the business, meaning profits not reinvested in the business. Okay, so that's kind of the gist of that first statement. And it is, even though it's the first statement that we talked about, is probably the most important one. Because I want to know how a business is doing. Like, I want to know how much money the business has, how much debt the business has. If I'm the owner, right? If I'm a shareholder, what is my equity worth? What is my position in this business, my ownership in this business? What is it actually worth? And to see all that, you want to look at a balance sheet or you want to look at a statement of financial position. Okay, cool. Number 2, the income statement or the statement of earnings. It has many names. Statement of comprehensive income if you're under IFRS, but we're going to keep it simple. Okay, an income statement or a statement of earnings. This one is not a snapshot. This one is a summary of a period. It could be a year or it could be a quarter. I mean, it could be any period. It could be monthly even, but generally it's either done quarterly or annually. And this one shows you revenues, expenses, and profit. Revenues, expenses, and profit. Revenue, the money you made. Well, the money you earned, right? So what are all the sales you made? What's all the money you were paid or you will be paid? What's all the money you earned? It's not profit though, right? Revenues is the money coming in. Expenses, that's, the fees you paid, the money going out basically. You paid your salaries to your employees, you paid your rent, you paid your marketing, you paid all these things. So revenues, money coming in, expenses, what are the fees or the money's going out. And then profit is the difference, okay? Net income is another way of saying profit, but it's basically revenues minus expenses. Revenues minus expenses. Easy, right? This is called a single step income statement. I put it here, not that I expect you guys will be asked to make one on your exams. You may have to make one for assignments, but why I like the single step income statement is that it really shows you that an income statement is at its core very simple. I just want to know how much profit we made. You take all your revenues. So you made money from sales, you made money on rent, you made money on interest. That's your total revenue. That's all the money you made. All of your expenses, this is all the costs that you incurred during the year, and you subtract them and you get your profit. Okay? Now, what we're going to make when it comes time to it, we're not doing it in this lesson, but what you ultimately have to be able to make is called a multi-step income statement, which looks like this. This shows you essentially the same thing, right? If you look, 796 here, that's our net income, and 796 here. But it's called a multi-step income statement because it shows you it in many steps, many important steps. For example, gross profit is the first step. Operating income is the next step. Income before tax, net income. It's different stages of your profit. I think we're gonna see this more in depth in chapter 3. What I want to talk about right now is kind of, what are revenues, what are expenses, but a little bit more in a little bit more detail. But the important thing is the income statement. Really, the main takeaway here is the income statement shows you over the period, and the period is always mentioned in the top. This is for the year that ended on December 31st, 2025. So this basically is Jan 1 to December 31, 2025. It's not always based on calendar years. Companies can decide to end their fiscal year. A fiscal year just means a business year. Fiscal year can end on August 31st. It could end on March 31st. It could end on April 30th. It really depends on whenever the business started and when they decided would be their year end. We're using December 31st because, it's simple. But the point is, this is showing you the total revenue you made. And up here, you can see the units. This is in thousands, which means this is 5,000 thousands. This is 5 million, in other words. This is 2.8 million. This is 1 million, and so on. Okay, so what are revenues? Revenues are the fees that you earn for providing goods and services, like it says very clearly there. But this is basically the fees you earn, not fees collected. And I know that might seem like a weird distinction to make, but it's very important in financial accounting, but accounting in general, to understand the difference between something you earned and something you collected. There's something called a cash basis, which we'll talk a little bit about in chapter 4, but we don't really use cash basis anymore. Only small businesses use cash basis. Everything is based on the accrual basis. Now, what does that mean, accrual? Accrual accounting means that you record things or you recognize things when they've taken place, not when the money is exchanged. Again, I know that seems like a weird distinction to make. Like, why aren't those two things the same thing? Let me give you an example. If you go to the store and you buy a pair of shoes, you take the shoe, you give the money. That one is very kind of clear. The store earned the money when they received it because they provided the shoes and got paid at the same time. But what if you ordered the shoes online and they came a month later? So you paid, let's say you paid for your shoes on May 10th, but they only delivered the shoes on, let's make it even further, July 4th. So and for the store that's selling the shoes, they collected the money in May, but they only earned it in July. Because earning something means you've actually provided the good or the service that you're being paid for. When you're collecting the money is actually not that important. It is ultimately important. Of course, you want to get paid. But as far as timing, not important at all. Because whether you got paid before, you got paid at the same time, or you're going to get paid later, what really matters is when did you earn the money? When did you provide? And you'll hear me talk about this and emphasize this as we work through these first several chapters. You always have to think about when did the action or the sale or the service take place? Not when was the money paid, or not when the money was paid, okay? So all that to say, guys, when you're looking at an income statement like this, and you see sales revenue, for example, and this is $5 million, this does not mean that you collected $5 million. It means that in the year between January 1st and December 31st, 2025, You earned 5 million in sales. Maybe you collected it, maybe you didn't. We don't know. We know that's what you earned. You provided goods in exchange for 5 million, but we don't know whether or not you've been paid. Okay? So that's what earned is. They could be operating or non-operating. Operating revenues are revenues that come from your main business. Okay, so we are a tutoring company. The revenue that we make from our tutoring services are considered operating revenues. We would call them either sales revenue or service revenue. Either one is fine. Non-operating revenues are revenues that come from secondary activities. Like if we were to earn, let's say we take our money, we put it in the bank pays us interest. That's a revenue because I'm earning money, but I'm not in that business of earning interest. I'm not a bank myself. Or maybe we have an office that we don't use and we rent it out to a lawyer who runs his business out of it. Then we're earning revenues from our real estate, but that's not our core business. So rent revenue in that context would be a non-operating revenue. So you see any revenue, anything you earn outside of your core business is classified as a non-operating revenue. For this class, sales and service revenue should always be considered operating. And unless specifically mentioned, you should consider all other revenues to be non-operating. Okay, you've got expenses. This is the opposite. These are fees paid or costs incurred for using goods and services. Okay, so revenues are fees earned for providing. Expenses are costs incurred for. And again, the word incurred is important. We'll talk about that. Using. So what is incurred? Incurred is the flip of earned. Incurred means you've used it. You've incurred a cost. It has nothing to do with whether or not you've paid it. So if this month, in the month of May, your employees work, you're incurring the cost of their salaries, whether you pay it or not, whether you will pay it eventually, but whatever was earned, whatever your employees earned in May was an expense for the month of May. Your rent for the month of May is an expense for the month of May. Whether you paid it in advance or you're going to pay it later, that has nothing to do with the word expense. Expenses are all the costs incurred in a given period. Okay, so again, when you look at an income statement like this one, and you see all these expenses, salaries expense, depreciation expense, administrative expense, and so on, these are the specific expenses for the services or the goods that you used in this year. That you used, not that you paid. Okay? And then profit is obviously the difference. Really nothing crazy there. Profit is the difference between your revenues and your expenses. And earnings per share, which you will see at the bottom of every statement, that is basically your profit divided into the number of shares. And I'm going to show you guys how to calculate this in chapter 3, but at a very high level, this is probably the most, on the income statement, the most important thing. Unless you own 100% of the business, the profits are not as important because the profit is the whole profit. But if you own 5 shares out of 1 million shares, that profit's not yours. Let me show you what I mean. Let's say the profit this year of a business is $1 million, okay? But that business has 100,000 shares, so that business is divided into 100,000 shares. A share is a piece of the business. Imagine what I'm saying here is your business is divided into, here, let's keep it super simple, okay? 4 shares. So if you were to take this business and look at it as a pie chart, it's divided into 4 slices. And let's say that you own 1 share, okay? Saying the business made $1 million is cool, I guess, but that $1 million is not yours. You don't own 100% of the business. So earnings per share takes that $1 million of profit and divides it into however many shares there are. So if there are 4 shares, like in this case, that's 250,000. This is what you earned for every share you own. So this is the most important thing because shareholders want to know, okay, how much did I make? I own 1 share. The profit was $250,000 per share. That's an important number. And usually it's not, for shares. Usually it's hundreds of thousands or even millions or hundreds of millions of shares, okay? So super, super important value. Again, there's a formula to it. I'll show you guys how to measure that. But in a nutshell, this is what it is. It's your profit divided into however many shares there are of the business, okay? That's number 2. Number 3, so those first 2 are highly, highly, highly likely to be on your midterm. I would go as far as saying almost 100% likely. You absolutely have to know how to solve, well, one, you have to understand obviously what they tell you, but also how to write them. The statement of changes in equity is more likely to be on the final because we have an equity chapter at the end of the course, but you still need to right now know what the statement is. So the statement of changes in equity is specifically about shareholders' equity, right? We talked about shareholders' equity already and how it's divided into 2 parts. Contributed capital is the money that we've invested into the business. Retained earnings is the profits of the business that are kept in the business. So the statement of changes in equity is really just telling you how did these 2 accounts change over the course of the period. So again, for the year ended, so for the entire year that ended on December 31st, these 2 accounts changed like this. We started the year with 645 of contributed capital, meaning 645, in this case, $1,000 were invested into the business on January 1st. Now, it doesn't mean that on January 1st that money was invested. Whenever you see beginning balances, this is called a beginning balance, or the balance at the start of the period. This is a continuation of the previous period. This means that in some previous period prior to January 1st, $645,000 was invested into the business. So that's how much we had at that point. It's like when you look at your bank statement and it tells you how much money you had at the beginning of the month, right? It doesn't mean you put that money in at the beginning of the month. It means that's how much you had left over from last month, right? That's what these numbers are. Beginning balances in accounting are just how much was left over from the previous period. Okay, so when we started the year, there was $645,000 invested into the business from previous periods and $230,000 of retained earnings. During the year, we issued additional shares. So this means we received an additional $5,000 invested into the business. So you can see that at the end of the year, if we add those up, now there's $650,000. During the year, we earned $796,000 in net income, but we paid out some dividends. So at the end of the year, our retained earnings balance is $1,001, or that would be $1 million, I guess. So the whole point of this is to show you, right? If I go back to the statement of financial position, the first one we did, it shows you how did we get to these 2 numbers? Why is my contributed capital $650,000 at the end of the year? Why is my retained earnings $1,001,000 at the end of the year? It's because these things took place. These events took place during the year. Hold on, let me find it. We received an investment, we earned some profits, and we paid out some dividends. Okay. And finally, you've got the cash flow statement. Now, you will not be asked to make a cash flow statement in this course. They removed that from the course, but you still need to know what it is, what is the main information you get from it. And what's most important is this first section, okay? But we're going to talk about all of it. Like the name suggests, the cash flow statement or the statement of cash flows is all about cash. At the end of the day, cash matters the most. A business needs to be able to generate cash from its core business. We need to be able to generate cash so that we can pay our expenses. You can have the best business in the world revenue-wise, but if you don't have any liquidity, you will go bankrupt. What I mean is you can make $1 billion this year in sales, but if you don't have the cash to pay your rent, if you don't have the cash to pay your workers when it's time to pay them, you're going to go bankrupt, okay? So this shows us all of the ins and outs of cash for the accounting period. It's separated into 3 sections: operating, investing, and financing. Operating is the main one. That's the most important one. Operating, that's your core business, your day-to-day. All the money that you've spent and all the money you've received from your core business. Ideally, a company is generating money in its core business. you don't want to have to rely on non-operating activities for cash. What do I mean by that? A business should be able, through its main activities, to generate cash to fund itself. Like I should be able to pay my workers from the money I get from my sales. I should be able to pay my rent from the money I make from my sales. I shouldn't have to borrow money to pay my workers, right? I shouldn't have to issue shares to pay my rent. My core business activities, my sales, should generate enough money to pay for my core day-to-day expenses. Those are my operating activities, your day-to-day. Investing in financing activities are non-operating activities. So investing activities, this really refers to the buying and selling long-term assets. Buying a building. It is not expected that if you're buying a building for $20 million, that you have to generate $20 million and pay for it from your sales. Because buying a building is not an operating activity. It's not something you do as a day-to-day thing. So we categorize them separately. So investing activities are really anything that has to do with buying and selling long-term assets. Buying buildings, selling buildings, renovating buildings, selling shares, purchasing computers, things like that. And then financing activities, these are the activities that have to do with these are the activities that are related to raising the money we need to finance things like buying a building. So to buy that building, maybe I have to go take out a loan. Buying the building is an investing activity, but taking out a loan is a financing activity. Issuing shares to raise money is a financing activity. Paying those shares, paying back my loans, paying dividends to my shareholders. These are all financing activities. But all three of these sections affect your cash. Because when you borrow money, you take out a loan, that's cash coming in. When you pay that loan back, that's cash going out. When you buy a building, that's cash going out. When you sell that building, that's cash coming in, right? So what we see in this statement is, where did our cash go? Where did our cash come from? And at the end of the day, it tells us how much cash we have. And so if I go all the way back, and I know there's a lot of back and forth, but if I go all the way back to my statement of financial position, you're going to start to see how all of these statements are connected. When you look at your statement of financial position, it tells you, hey, on December 31st, you had $600 in cash. Okay, what if I wanted a much deeper explanation? Then you would look at your statement of cash flows, and it would say, okay, look, during the year, your core business brought in $829,000 of cash. That's what that line represents. Cash from operating activities. You spent, this is negative, brackets means negative. You spent $335,000 on financing activities by buying a building, and then you sold some land. Your financing activities were a wash. So you ended up at zero. You received some money by issuing shares. You borrowed some money, but then you also paid dividends, so I ended up with zero. But if you put all these together, your cash during the year changed by $494,000. In other words, it increased by $494,000. So you started the year with 106. You added another $494,000, and that's how you ended up at $600,000. And I know you're looking at this and saying, "Oh my God, that's so much information." I know, guys. This is what the entire semester is based on. You don't have to. You should understand generally what we're talking about here, but we have 12 chapters to explain all the little details that I just spoke about. But the point is, all of these financial statements, the goal is that somebody who's interested in how the business did financially, for many different ways. It could be because they want to lend you money. So you go to the bank and you're saying, "Hey, I want to borrow money." They're going to say, "Well, let me see your financial statements." You want to receive investments? Investors are going to be like, "Well, let me see your financial statements." So, but we need to see all the details. Telling me you have $600,000 in cash is great, but I want to know, okay, show me how you got to that number. Show me what was your change in cash this year and why. So I can look at this statement for that. What was your profit this year? I could look at your income statement for that. Why did your equity change the way it did? I could look at your statement of equity for that. But it all comes back to that first statement, the statement of financial position. Everything ends up there, okay? So that is the gist of those 4 financial statements. We don't have much left here to talk about. You have okay. So you have 3 types of business entities. And this is the long form explanation, but you also have a kind of condensed table here. But essentially, there's 3 ways to organize a business. There are proprietorships, partnerships, and corporations. These 2, the proprietorship and the partnership, are not considered separate legal entities. What does that mean, a legal entity? A legal entity is basically a separate person from the owner. So when you have a business that's organized as a proprietorship, so this is the most or the simplest form of business. You don't have to do anything special. Tomorrow, if you said, "Hey, I want to start a business and I want to just mow people's lawns," so you went and knocked on your neighbor's door and said, "Hey, can I mow your lawn? I'm starting a business." You're basically a proprietorship. You, the person, and the business are the same, one and the same. When the government looks at you and looks at your business, they see the same thing. What are the pros and cons? The pro is that it's very simple to organize. It doesn't really cost anything to organize. It doesn't cost very much to upkeep it. When you do your taxes, for example, it's all the same. It's all the money your business made is your personal income, and so you file a personal tax return, and it's very simple. But the main con here is that you have unlimited liability. What does that mean? We just talked about how businesses have debt and need debt. Ultimately, you need debt as a business if you want to grow. But as a proprietorship, the debt is your debt. Unlimited liability means you are totally and personally responsible for all of the business's debts. So if you went and borrowed $200,000 to buy a truck so that you could run your business, you are personally liable to pay it back. Even if your business fails, you can't avoid that. And if the business goes bankrupt, you are bankrupt, and vice versa. Partnerships are the exact same thing. The only difference between the two is that in a proprietorship, there's one owner. In a partnership, there's 2 or more. Other than that, the same thing. You and I together decided we're going to start a lawn mowing business. Now we're a partnership. But we are both unlimitedly liable, if that's a word. We both have unlimited liability. We now personally owe $200,000 for that truck. Then you've got corporations. Corporations are, first of all, separate legal entities, meaning that in the eyes of the law, in the eyes of the government, it's a separate person from the owner. You have Apple as a separate legal entity, meaning it has to file its own tax returns. It can sue people and it can be sued by people. It is seen as a completely separate person from its owners. The shareholders, the people who own shares in Apple, are not seen as being one and the same. They just own pieces of Apple, but Apple is a standalone entity. So, the main pro here is liability protection and risk protection. The shareholders they have limited liability. Limited liability means you are not personally responsible for the debts. The most that you can lose is whatever money you've invested into the business. So if you bought shares in Apple and you spent $10,000, that's all you can lose. If Apple were to go bankrupt tomorrow, you would lose your $10,000 investment, but that's it. They wouldn't come knocking on your door and saying, "Hey, Apple owes like $200 trillion, so you're going to have to pay it." Okay. So, of course, that's one of the advantage. The main disadvantage is it is more complicated. So if you're a small business, you don't even really want to be a corporation necessarily because one, it's more expensive to upkeep. There's more regulation and more complex financial reporting, meaning that the business itself needs a tax return. So it pays taxes and then you have to take money out and you're going to pay taxes again, which is what we call double taxation. So yeah, that's the main difference between those three. I've summarized it here as well. Okay. Finally, just a quick note on accounting standards. What we're going to be learning in this class, is how to prepare these financial statements, how to record transactions, how to calculate certain things in a very specific way. And all of these things we're going to be learning are the accounting standards, or what we call the generally accepted GAAP. So generally accepted accounting principles that specific organizations have kind of adopted or have determined these are the standards, these are the principles that everybody has to follow when it comes to accounting. So in Canada, we have IFRS, which is, it's not just in Canada, by the way, but since this is a Canadian course, we're talking about it. The International Financial Reporting Standards. Many countries will follow this one. The U.S. doesn't. The U.S. uses U.S. GAAP, which is very similar. But basically, Canadian publicly traded companies, so publicly traded means that it's publicly traded. It's sold, it's traded on the stock market, it's owned by the public. All Canadian public companies have to use IFRS. They have to use the specific standards that IFRS, we just call those standards IFRS. Private companies don't have to follow IFRS. They can follow what's called Private Entity GAAP, or ASPE, Accounting Standards for Private Enterprises. Now, this is an intro class, so we are not, other than this right now, we're never going to talk about this again. But for those of you that are majoring in accounting, so you're going to take ACCO 310 pretty soon, and I suggest you take it as soon as possible, there you're really going to be getting into the details of what is IFRS, what is ASPE, and how to do things in both or under both standards. For now, guys, just understand there are two sets of standards. There are two sets of rules, in other words, two sets of principles that we use. IFRS for public companies, ASPE for private companies. You can also remember that the IFRS is produced by the IASB, the International, I don't know why that's not pink, but International Accounting Standards Board. This is just the board, the group of people, the organization that sets the rules, that makes the rules. And when I say the rules, if you're wondering what rules you're talking about, let me show you a very basic example. Why is a building a non-current asset? I said it was because a building is used by more than 12 months, and the definition of a non-current asset is any asset that you're going to use in a period that is longer than 12 months. But who decided that? Well, this board did. So all the rules that we're going to be talking about throughout this semester, why is depreciation calculated the way it is? Why do we write adjusting journal entries the way we do? We're actually not going to see journal entries in this course, but the point is all of the different rules that you're going to be learning over the next 12 chapters, those rules are made by someone, right? It's these boards that made those rules, and those rules are called IFRS and ASPE, okay? So that is all for this lesson. I hope that you found it useful. And if you have any questions at all, you guys know where to reach me. But in case you don't know where to reach me, I will give you my contact info. So whether you're watching this as part of the course, or if you're watching this on YouTube, you feel free to use this. You can DM me on Instagram anytime at prof.johnk. If you are watching this on YouTube, you can leave a comment directly here. You can write me an email, johnk@checkmarktutorials.com. You can contact me anytime for anything. I'm happy to help. Okay. Thank you so much. See you next time.